Let me tell you about the hardest decision I ever made in my investing career. It wasn't about timing the market perfectly. It wasn't about predicting some dramatic crash or boom. It was about letting go of something I believed in deeply and embracing what I had been resisting for years. I'm talking about the day I sold my silver position and committed fully to gold. Now, before you think this is just another story about picking the winning horse, let me be clear. This isn't about silver being bad or gold being magic. This is about understanding what you truly need from your investments, recognizing when your strategy no longer serves your goals, and having the courage to make a change even when it feels uncomfortable. The decision cost me sleep. It challenged my ego, and it forced me to confront some hard truths about investor psychology, portfolio construction, and the real purpose of precious metals and wealth preservation. Today, I'm going to walk you through this journey, not because I want you to copy my exact moves, but because the principles behind this decision apply to every serious investor trying to build lasting wealth in an uncertain world. We're going to examine why both metals matter, what makes them fundamentally different, and most importantly, how to think clearly about your own position in precious metals without getting swept up in ideology or emotion. This is a conversation about strategy, discipline, and understanding your true financial objectives. Let's begin. For years, I was a silver believer. The arguments were compelling. Silver is both a precious metal and an industrial commodity. It has all the monetary history of gold, but trades at a fraction of the price. The gold to silver ratio historically averaged around 15 to 1, yet it had stretched to 80 or even 100 to 1 in recent years. The math seemed obvious. If that ratio reverted to historical norms, silver would massively outperform gold. You could buy more ounces for the same money. The leverage potential was real. Beyond the ratio argument, silver's industrial applications were growing: solar panels, electronics, medical devices, water purification systems. The green energy transition alone seemed to guarantee increasing demand while supply remained constrained. Every analysis I read pointed to the same conclusion. Silver was undervalued, overlooked, and positioned for extraordinary gains. I accumulated steadily. I studied the market. I watched the forums and followed the analysts who shared my conviction. I felt smart, contrarian, and ahead of the curve. But something began to shift in my understanding. It started with a simple question. What am I actually trying to accomplish with precious metals? Was I speculating on industrial demand? Was I betting on a ratio reversion? Or was I trying to preserve wealth across economic cycles and currency debasement? The more honest I became with myself, the more I realized my silver position was based on hoping for profit, not on protecting what I had already built. And that distinction changed everything. Gold and silver are not the same asset wearing different price tags. Yes, both are precious metals. Yes, both have been used as money throughout human history. But their roles in a modern portfolio are fundamentally distinct, and confusing them leads to poor decision-making. Gold is primarily a monetary metal. Central banks hold gold. Sovereign wealth funds allocate to gold. In times of currency crisis or geopolitical instability, capital flows to gold. It is liquid, recognized globally, and serves as the ultimate store of value outside the banking system. Gold's industrial uses are minimal compared to its monetary demand. When you own gold, you own something the world treats as money in its purest form. Silver, on the other hand, is a hybrid. Roughly half of silver demand comes from industrial applications. The other half comes from investment and jewelry. This dual nature creates a different kind of volatility and a different risk profile. When industrial demand weakens during economic slowdowns, silver gets hit from both sides. Investment demand may rise as people seek safe havens, but industrial demand collapses. The result is often severe price swings that don't correspond cleanly to monetary factors. Gold, by contrast, often performs best exactly when economies are struggling, because its value proposition is not tied to manufacturing activity or technological consumption. Think about what happens during a recession. Industrial metals fall because factories slow production. Copper drops, aluminum drops, and silver, with its significant industrial component, tends to follow them down, at least initially. Gold, meanwhile, rises as central banks ease monetary policy, as investors lose confidence in currency stability, and as the search for safety intensifies. This isn't a theoretical distinction. It's observable across decades of market cycles. Understanding this difference forced me to ask, if I'm holding precious metals for wealth preservation and insurance against monetary instability, why am I betting on an asset whose price is partially determined by factory output? Let me raise another issue that many silver investors don't fully consider: liquidity. When you need to convert your precious metal holdings into cash quickly, or when you need to move them across borders, or when you need to use them as collateral, liquidity matters enormously. Gold is universally liquid. You can sell significant amounts of gold in any major city in the world within hours. 1-ounce gold coins and bars are standardized, recognized, and easily traded. The bid-ask spreads are tight. The market depth is substantial. silver presents different challenges. First, there's the bulk problem. Because silver trades at roughly 1/80th the price of gold, accumulating meaningful value in silver means holding substantial weight and volume. $100,000 in gold fits in a small safe. $100,000 in silver requires serious storage space. This isn't just inconvenient. It affects your ability to transport, secure, and liquidate your holdings efficiently. Second, the premiums on physical silver tend to be higher as a percentage of spot price than gold. When you buy silver coins or bars, you often pay 15 to 30% above spot. When you sell, you receive less. This round-trip cost erodes returns significantly. Third, in a genuine crisis, scenario where you might need to use precious metals for transactions or for emigration, gold's superior portability and universal acceptance become critical advantages. I had to confront the reality that my silver stack, while impressive in ounce count, was less practical for the very scenarios I was supposedly preparing for. Silver advocates often celebrate the metal's volatility as proof of its leverage potential. And it's true, when silver runs, it can run hard. The moves can be spectacular. The percentage gains can dwarf gold's more measured appreciation. But volatility cuts both ways. During the March 2020 market panic, silver initially crashed harder than gold. While gold experienced a brief dip before rallying, silver plunged more than 30% in a matter of weeks. Yes, it recovered later, but in the moment of maximum fear, when you theoretically need your safe haven asset most, silver behaved more like a risk asset than a refuge. This pattern repeats throughout history. In 2008, silver fell from over $20 to below $9, a decline of more than 50%. Gold fell too, but by much less, and recovered far more quickly. The question I had to ask myself was this: can I emotionally handle 50% drawdowns in an asset I'm supposedly holding for stability and wealth preservation? And more importantly, should I have to? The purpose of holding precious metals, at least for me, was to reduce portfolio volatility and provide insurance against monetary chaos. If my precious metals allocation itself was introducing extreme volatility, it was working against that purpose. I realized that chasing silver's upside potential had subtly transformed my precious metals position from insurance into speculation. That wasn't what I needed. Here's where things get personal and where I believe many investors lose their way. Silver has a passionate community. The online forums, the YouTube channels, the newsletters, they all create a powerful narrative ecosystem. It becomes tribal. There's an us versus them mentality. The enlightened silver bugs versus the uninformed masses. This community reinforces itself constantly. Every piece of news gets interpreted through the lens of this is bullish for silver. Every setback is explained as manipulation. Every delay in the anticipated price explosion is just proof that the explosion will be even bigger when it finally arrives. I was part of this community. I consumed the content. I believed the narrative. And slowly, without fully realizing it, I became emotionally invested in being right about silver, not just financially invested in the metal itself. This is dangerous. When your ego becomes attached to an investment thesis, you stop evaluating evidence objectively. You dismiss contradictory data. You rationalize poor performance. You hold on to losing positions far longer than strategy dictates, because selling feels like admitting you were wrong. The silver community, for all its knowledge and passion, can trap investors in this psychological loop. Gold holders, by contrast, tend to be less ideological. Gold is boring. It's established. It doesn't promise dramatic ratio reversions or imminent price explosions. It just sits there, doing its job as a monetary anchor. That boring quality turned out to be exactly what I needed. When I finally admitted to myself that I had become emotionally overattached to silver, it created an opening for clearer thinking. The decision to sell my silver and consolidate into gold didn't happen overnight. I spent months working through the analysis. I tested my assumptions. I looked at historical performance across different economic environments. I examined what central banks hold, what sovereign wealth funds allocate to, what institutions treat as the ultimate reserve asset. The answer was always gold. I also looked at my broader portfolio. I had equities for growth. I had real estate for income and inflation protection. I had cash for liquidity and opportunities. What I needed from precious metals was simple: stability, universal acceptance, and proven wealth preservation across centuries and across every type of economic regime. Silver's industrial component, volatility profile, and bulk characteristics were solving for a different problem, a problem I didn't actually have. So I made the move. I sold my silver position gradually over several months, avoiding the emotional trap of trying to time the perfect exit. I converted the proceeds into gold, focusing on 1-ounce coins and bars with maximum liquidity and recognition. The immediate effect was surprising. I felt lighter. The constant checking of silver prices, the monitoring of industrial demand data, the emotional investment in ratio arguments, all of that mental burden lifted. My precious metals allocation became simpler, clearer, and more aligned with its actual purpose in my overall wealth strategy. let's step back and examine how precious metals actually perform across different market environments. This context is essential for understanding what you truly need from your allocation. In periods of economic expansion and low inflation, both gold and silver tend to underperform stocks and other growth assets. This makes sense. When confidence is high and currencies are stable, the insurance value of precious metals is less appreciated. In periods of high inflation with economic growth, the stagflation scenario, gold typically performs extremely well. Silver performs well too, though with greater volatility. The monetary debasement narrative dominates and hard assets benefit. In deflationary crashes and credit crises, gold serves as the ultimate safe haven. Silver often sells off initially along with industrial commodities, then recovers as monetary stimulus kicks in. In currency, crises, or geopolitical instability, gold outperforms dramatically. Silver benefits too, but gold's monetary premium expands faster. Notice the pattern? Silver's best environments are the same as gold's best environments, but silver introduces additional variables tied to industrial demand and risk appetite. Gold's performance is cleaner, more directly tied to monetary factors, and more reliable as crisis insurance. If your precious metals allocation is meant to be the steady hand in your portfolio, the anchor during storms, gold fulfills that role more consistently. Markets are not perfectly rational machines. They're driven by human beings with emotions, biases, and behavioral patterns. Understanding investor psychology is crucial to understanding precious metals. Fear and greed dominate short-term price movements. In both gold and silver, speculative manias can drive prices to unsustainable levels, followed by brutal corrections. But there's a difference in how institutional versus retail psychology affects these markets. Gold attracts massive institutional flows. Central banks, pension funds, hedge funds, these entities move billions into and out of gold based on macro outlooks and portfolio allocation models. This institutional participation provides a floor of steady demand and creates more orderly markets. Silver, by contrast, sees disproportionate retail participation and speculation. Retail investors are more emotional, more prone to panic selling and FOMO buying. This amplifies volatility. When I held silver, I was essentially betting alongside a less stable investor base, and that betting pool's behavior would directly affect my returns regardless of fundamentals. With gold, I'm aligned with the most sophisticated institutional investors in the world. Central banks aren't panic selling gold when markets wobble. This alignment matters more than most investors realize. If you currently hold silver, you're probably asking, should I make the same move? The answer depends entirely on your specific situation and objectives. First, be honest about why you hold silver. If you're holding it because you believe in the industrial demand thesis and you're comfortable with the volatility, that's a legitimate investment choice. Just make sure it's appropriately sized within your portfolio and you have the emotional discipline to handle significant drawdowns. If you're holding it as a monetary hedge and wealth preservation tool, seriously examine whether silver's characteristics align with that purpose better than gold. Second, consider your time horizon and liquidity needs. If you might need to access this value in the next few years, gold's superior liquidity and lower transaction costs make it more practical. If this is a multi-decade hold and you have no need for flexibility, the difference matters less. Third, look at your total portfolio allocation. If precious metals represent 5% of your net worth, the choice between gold and silver is less critical. If they represent 20 or 30%, the characteristics of what you're holding become very important. For those deciding to shift from silver to gold, do it methodically. Don't try to time the gold-silver ratio perfectly. You'll drive yourself crazy and likely get it wrong. Instead, establish a transition plan over several months. Sell silver gradually, buy gold gradually. Focus on the strategic outcome, not on squeezing out every last basis point of relative performance. And most importantly, let go of any emotional attachment to being right about silver. The market doesn't care about your ego. Your portfolio's job is to serve your financial goals, not to validate your analytical prowess. If you're just beginning to consider precious metals, you have the advantage of a clean slate. Here's how to think about this clearly. Start by defining the role you want precious metals to play. Are you looking for portfolio insurance against monetary instability and currency debasement? If so, gold should be your primary or exclusive precious metals holding. Are you speculating on an asymmetric bet with industrial demand fundamentals? Then silver might make sense as a small, speculative position separate from your core wealth preservation strategy. For most investors, a straightforward allocation to physical gold, 5 to 10% of investable assets, provides meaningful portfolio benefits without unnecessary complexity. Buy gold that's easily recognizable and liquid. 1 ounce government-minted coins like American Eagles, Canadian Maple Leafs, or South African Krugerrands are ideal. 1 ounce bars from reputable mints work well too. Avoid exotic coins, collectibles, or anything that trades at huge premiums to gold content. You're buying gold for its metal content, not its numismatic value. Store it securely. A home safe for modest amounts is fine. For larger holdings, allocated storage through reputable vaulting services provides insurance and professional security. Most importantly, buy your gold and then ignore it. This isn't a trading position. This isn't something you should be checking daily or trying to optimize by jumping in and out. Gold is insurance. You buy it, you hold it, and you hope you never desperately need it. If you absolutely want silver exposure, limit it to a small percentage of your overall precious metals allocation. Understand that you're taking on additional volatility for the potential of higher returns, and structure your position size accordingly. Never let precious metals dominate your portfolio. They don't produce income. They don't grow earnings. They sit there, preserving value but not creating it. Your wealth building should come from productive assets, businesses, real estate, your own skills and earning power. Precious metals are the shock absorbers, not the engine. Let me be direct about the most damaging behaviors I see in precious metals investors. Every week, someone is calling for gold to hit $10,000 or silver to reach $500. These predictions are worthless. Nobody knows where prices will be next month, next year, or next decade. If you're waiting for the perfect entry point or the predicted explosion, you'll either never buy or you'll buy at the worst possible time driven by FOMO. Buy based on allocation strategy, not on price forecasts. I've seen investors put 50, 60, even 80% of their wealth into gold and silver. This is reckless. When the inevitable multi-year stagnation or decline happens, these investors become financially paralyzed and psychologically devastated. They miss opportunities in other assets and often sell at the worst possible time out of desperation. Discipline yourself to reasonable allocation percentages. Precious metals are not good trading vehicles for most investors. The spreads on physical metal eat into returns. The timing required to profit from volatility is extremely difficult. And the emotional toll of watching your supposed safe haven swing 20 or 30% undermines the whole purpose of holding it. Buy, hold, rebalance periodically if needed, but don't trade. Gold and silver are not going to make you wealthy. They're going to preserve the wealth you've already created through productive work and smart investing in growth assets. If you're looking to build wealth from a small base, you need earnings growth, business ownership, and skill development. Precious metals are for protecting what you've already built. Adjust your expectations accordingly. Before you buy a single ounce of gold, you should have an emergency fund, manageable debt levels, adequate insurance, and a diversified investment portfolio. Precious metals come after you've built a solid financial foundation, not before. Don't skip the basics in pursuit of sexy alternative assets. The precious metals world is full of apocalyptic scenarios, conspiracy theories, and emotionally charged rhetoric. Some of it may contain grains of truth, but when you make investment decisions based on fear or tribal identity, you almost always make poor choices. Stay rational, stay grounded. Focus on principles, not on narratives designed to provoke emotional reactions. Whether you hold physical metal or use allocated storage, verify everything. Test your gold with a reliable assay method. Audit your storage facility. Understand your insurance coverage. The precious metals market has its share of frauds and counterfeits. Trust, but verify, always. To understand precious metals properly, you need to understand the monetary environment we're living in. Since the 2008 financial crisis, central banks have engaged in unprecedented monetary expansion. Interest rates have been suppressed to historic lows for extended periods. Government debt levels have exploded across developed economies. Currency debasement, while not always visible in consumer price inflation, has been the dominant trend. This environment is fundamentally supportive of gold's role as an alternative to fiat currency. At the same time, we face significant uncertainties. Will inflation remain elevated? Will central banks maintain tight policy? Will we see currency crises in major economies? Will geopolitical tensions escalate? Nobody knows the answers. What we do know is that across human history, when trust in institutions and currencies weakens, gold reasserts its value. This isn't mysticism. It's observable pattern recognition across thousands of years. Gold isn't betting on a specific outcome. It's insurance against the full range of monetary and political risks. Silver, with its industrial demand component, is making a more specific bet on continued economic growth combined with monetary expansion. That's a narrower scenario. When I'm thinking about the next decade or two, I don't want to bet on a specific scenario. I want insurance that works across multiple possible futures. That's what gold provides. Throughout this discussion, one theme keeps emerging: discipline. Discipline in defining your investment objectives clearly. Discipline in sizing positions appropriately within your overall wealth strategy. Discipline in ignoring the noise, the predictions, and the emotional narratives. Discipline in holding through periods of poor performance without panic selling. Discipline in not overtrading or constantly second-guessing your strategic allocation. The investors who succeed with precious metals over the long term are not the ones with the most sophisticated market timing or the deepest technical analysis. They're the ones with the clearest thinking and the strongest discipline. When I shifted from silver to gold, the biggest benefit wasn't the financial performance, though that worked out well. The biggest benefit was the clarity and peace of mind that came from aligning my holdings with a well-defined purpose. I stopped trying to be clever. I stopped chasing leverage. I stopped hoping for dramatic outperformance. I simply held gold as insurance, proportional to my overall wealth, and focused my energy and attention on the productive parts of my portfolio that actually build wealth. That mental shift was worth more than any price appreciation. So where does this leave us? I can't tell you what gold will do next month or next year. I can't promise that choosing gold over silver will deliver better returns over any specific time period. What I can tell you is this: if you're holding precious metals for the right reasons, wealth preservation, portfolio insurance, protection against monetary instability, gold fulfills that purpose more reliably and with less complication than silver. If you're speculating on industrial demand growth or betting on ratio reversion, silver might be appropriate as a small speculative position. Just recognize it for what it is and size it accordingly. For me, giving up silver and committing to gold wasn't about abandoning a losing position. It was about gaining clarity on what I was really trying to accomplish. It was about letting go of the seductive narratives and focusing on principles that have stood the test of time. It was about building a portfolio structure that serves my actual needs rather than my ego's desire to be proven right about some clever contrarian thesis. The irony is that by giving up the pursuit of leverage and outperformance in my precious metals allocation, I actually improved my overall investment outcomes. My portfolio became more resilient, my stress levels decreased, my decision-making improved across all asset classes. Sometimes, the path to better results is through simplification and clarity, not through complexity and cleverness. The decision to sell silver and hold gold instead taught me something fundamental about investing. The best strategy is the one you can stick with through all market environments, while staying aligned with your actual financial goals. It's not about finding the asset with the highest potential return. It's about building a portfolio structure that gives you the resilience to survive bad times and the discipline to benefit from good times. Precious metals, and gold in particular, are not exciting. They don't offer the thrill of rapid gains or the intellectual satisfaction of complex trading strategies, but they offer something more valuable: stability in a world of constant monetary and political uncertainty. If there's one message I want you to take from this, it's this: be honest about what you need from your investments and structure your holdings to serve those needs, not to satisfy your ego or feed your excitement. For most serious investors building long-term wealth, a straightforward allocation to physical gold provides meaningful benefits without unnecessary complexity. Keep it simple, keep it disciplined, and remember that the goal isn't to get rich from precious metals, it's to preserve the wealth you're building elsewhere. The world will continue to offer uncertainty, volatility, and crisis. Your portfolio's job is to give you the financial stability and peace of mind to navigate whatever comes, staying focused on what you can control, your strategy, your discipline, and your long-term vision. That's what giving up silver and holding gold taught me, and that's the foundation of sound wealth preservation in any era. Thank you for your time and attention. Stay disciplined, stay focused, and invest with clarity and purpose.